Hello, I'm Alex from Investomation, and today we'll talk about the fundamentals of investing. Since this is our first episode, I'll take a couple minutes to talk about my own background and about Investomation. I'm a software developer with over a decade of investing experience. Over the years, I've written multiple tools to improve my investing research. I started investing into stocks in 2008, then transitioned to real estate in 2014. I found real estate a better vehicle for long-term investing. It had better tax treatment and easier access to leverage. It was a quote from a book that piqued my interest in real estate. The quote is that 75% of all millionaires make their wealth in real estate. The other 25% is stocks, entrepreneurs, celebrities, and inheritance combined. That's pretty good odds if you ask me. Recently, our team started investing into cryptocurrencies as well. We knew about them for a while, but sat on the sidelines until we saw institutional adoption. Crypto has a great synergy with real estate and will be one of the asset classes I'll cover on this channel. After a few years in real estate, I started Investomation, a company for automating real estate research. We currently own several buildings across the US and have bundled our real estate investing analysis tools into this web app. The website is investomation.com. Please check us out. It's free to get started. The best way to understand each asset class is to think of it in terms of what the asset represents and the utility of said asset. Stocks represent shares of a business and their utility is to share net revenue with the business itself. Real estate represents physical space you control. Utility can be anything from renting it out to personal use. Crypto represents digital channel for business transactions, typically product built by a business where you buy shares of the product instead of the business itself. And crypto's utility is to share gross revenue with the business itself. One important nuance to understand is that when investing in stocks, you get paid out of net revenue, after all expenses have been paid out. With cryptocurrencies, you get paid out of gross revenue. Your shares of the asset are effectively a franchise of the business. People who don't understand this end up buying shitcoins with no utility, pumped up by nothing more than hype and speculation. People who do understand this end up making a lot of money. Next, I want to touch upon the fundamental concepts of investing. Understanding these concepts and their interaction is crucial to your success as an investor. These concepts are inflation, appreciation, dividends, leverage, liquidity, and operating costs. I'll use these concepts as a measuring stick for each asset class to explain what benefits each one has and where each asset class falls short. Inflation is erosion of wealth, a tax on money that doesn't circulate through the financial system. Taming inflation is crucial to investing, otherwise you'll be losing money long term. I won't go into it in depth on this episode, but you should definitely read my blog post on it, which I'll leave in the video description. The main takeaway of the blog post is that real inflation is significantly higher than the 2% per year figure US Labor Bureau claims. If you want to learn more on this topic, research the difference between CPI, Consumer Price Index, which is the figure the government uses, and RPI, Retail Price Index, figure used by economists tracking real inflation. Why would the US government lie to you about inflation? Because it makes them look better and you less angry about them eroding your savings. Stocks tend to keep up with inflation and slightly outpace it. Real estate always keeps up with inflation because that's where a big portion of the money supply eventually settles. Cryptocurrencies are currently outpacing inflation, but this rate of growth is unsustainable and will eventually plateau after they fully merge with the existing financial system. The second concept is appreciation, which is the difference between current price and the purchase price of the asset. The ultimate goal of each investor is to buy assets that go up in value with time. Appreciation alone isn't enough. Your asset's appreciation should also outpace inflation. Otherwise, you lose purchasing power with time. You don't necessarily need to sell the asset to take advantage of its appreciation, and this is a powerful tool in an experienced investor's arsenal. Just like you can open up an equity line against your house, you can take out a loan secured by stocks or cryptocurrencies. Depending on the volatility of the asset, however, this may not always be a good idea. Next concept is dividends. a periodic payment your asset generates. This takes the form of dividend-paying stocks in the stock market and rental properties in real estate. In crypto, dividends take the form of staking and liquidity mining. Dividend investing is one of the safest and most powerful ways to scale your wealth, and one of the least appreciated by beginners. Dividend investing basically turns your assets into a business that generates ongoing cash flow. This cash flow tends to keep up with inflation and also generates income to offset ongoing operating costs. This is especially true for real estate, which has some of the highest operating costs. The fourth concept is leverage. Leverage is the ability to obtain more capital using initial asset as collateral. All asset classes allow leverage, but using it is usually not a good idea. The main problem with leverage is that the lender can liquidate your asset if its price drops below the loan amount. This is called a margin call in stocks and crypto. The only exception to this is real estate, where leverage is relatively safe. You can still get foreclosed on, but your loan won't be called due just because your house depreciated, as long as you continue making payments. Leverage can be a powerful tool in your arsenal or a recipe for disaster. Whatever inflation does to your assets, leverage amplifies. Whatever appreciation does to your assets, leverage amplifies. Whatever dividends your assets generate are also amplified by leverage. Unfortunately, so are the operating costs. The fifth concept is liquidity. Liquidity is the ability to convert your asset into cash quickly. Stocks enjoy the highest liquidity. You can enter and exit positions in seconds. Crypto is very liquid as well, but less so than stocks. It's a growing asset class with speculation. This speculation causes huge swings in crypto's liquidity, contributing to its volatility. With time, this volatility should subside and liquidity will increase. One of the main arguments for cryptocurrencies being underpriced is the amount of liquidity within the ecosystem. It can do everything the current banking system can do faster and cheaper, and yet its current locked-in liquidity is only a tiny fraction of that. Out of the three, real estate is the least liquid asset class. It often takes months to complete a sale. However, this lack of liquidity contributes to real estate stability compared to other assets. When you have to plan your sale ahead of time, you're less likely to overreact to the news. The final concept to discuss is operating costs. This includes taxes, insurance, fees, and any sort of maintenance. Because you're dealing with net revenue, stocks already have most of their operating costs priced in. This doesn't mean you should glaze over them, however. Otherwise, you can end up investing in another enron. Understanding the operating costs of a business you're investing in is key to understanding whether this business has a future. Real estate suffers from the highest operating costs, but also enjoys some of the most generous tax breaks. Just like local regulations, real estate operating costs vary significantly across the US, as do the risks, which is why I advise against investing in a single geographical area. Crypto operating costs consist of fees charged in transactions. Depending on which side of the transaction you're on, you're either collecting that fee or paying it. The more efficient the ecosystem is, the lower the fees. This is the main pet peeve investors currently have with Ethereum. The DeFi within the ecosystem is currently unusable due to high operating costs. It is this problem that chains like Cardano, Harmony, Solana, and Polygon aim to address. Let's recap. Cash does poorly with inflation, it doesn't appreciate, and the interest you can get on it at a local bank is pretty low. However, because of its safety, it's very liquid and so widely accepted that operating costs on it are effectively zero. Stocks appreciate with inflation or company growth. Some stocks pay dividends, high leverage is usually only available to institutional investors, and use of leverage for individuals, even when available, is risky due to margin calls. Liquidity is relatively high for a typical blue chip stock and low for penny stocks. Real estate appreciates with inflation or regional growth. There are dividends in the form of rentals, and highly safe leverage that can be margin called is available to everyone in the form of mortgage. Leverage is one of the main benefits real estate has going for it because you can use it to consistently outpace inflation. Liquidity is relatively low compared to other asset classes and operating costs are significantly higher. However, it's this variation in operating costs that's the reason for favorable tax treatment. If there is one thing I learned from investing, it's that inefficiencies create opportunities. You may wonder why I'm making such a big deal about leverage. Let's take a look at a quick example. Say we have a typical $100,000 home. Bob buys the home with cash and Ashley takes out a conventional mortgage. A year later, the home appreciates, about 5%. Now the house is worth $105,000. Bob made $5,000 and so did Ashley. However, this $5,000 represents 5% return on investment for Bob and 25% return on investment for Ashley. Cryptocurrencies appreciate with inflation or project growth. Also appreciate due to crypto sector growth in general, but this is temporary growth until crypto is more mainstream. Dividends take the form of supplying services or liquidity to the ecosystem. Leverage is available but very risky. Liquidity is rapidly growing, and it's this liquidity that's creating both growth and volatility we're currently seeing. Some mistake crypto's growth for a bubble, but if you look at its fundamentals and amount of money currently in it relative to other asset classes, you realize that this asset class as a whole is underpriced. This doesn't mean that we'll be seeing $1 million Bitcoin anytime soon. Most of the growth will be in new ecosystems that are forming, such as Polygon, Solana, Harmony, and other new growing DeFi ecosystems. We will definitely experience bubbles along the way, as we always do in rapidly growing industries. However, even if we were to invest into Amazon or PayPal at the height of the dot-com bubble, you would still be way ahead today. The key to successful investing is understanding the project you invest in and holding on to it even when others are panicking. Crypto opens a lot of new doors and use cases, such as standardized payment system between countries, consistent global banking infrastructure, new lending platforms, new ways of project funding, new ways to earn income, new payment networks, and remote work opportunities. Each cryptocurrency is a decentralized entity that grows separately from the business that spawned it. Right now, most of the emphasis is on speculative appreciation, but there's a lot more to decentralized finance. 2020 has changed the landscape of investing a lot. With the amount of monetary supply that has entered our financial system, inflation is imminent, and we're already seeing it in some industries. The financial system is evolving, and money is changing hands. If you understand this change, you have tremendous opportunity to build wealth. If you don't understand it, you'll see yet another dot-com boom pass you by. I hope you learned something today. If you did, please like this video and subscribe to our channel. Next week I'll talk about decentralized finance, or how you can be the bank in crypto.